Hello, everyone. Today on the final bar, a decidedly meh day for stocks with the S&P 500 unchanged essentially from Friday's close. Mega cap technology stocks doing just fine, though. We'll talk about Microsoft, Apple, Nvidia. Finally, we'll do a live Q&A today on the show. What's on your mind? What questions are coming up as you are trying to break down these current markets? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the Final Bar. Happy Monday. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. The StockCharts platform was really designed decades ago to empower individual investors to understand the markets using technical indicators, using price and breadth and sentiment and trend and momentum indicators to try to make sense of things. And I think now more than ever here in 2023, what I hope you're finding is that a consistent process of analyzing charts and breaking down movements can really help you understand sector rotation, asset allocation shifts, and really those macro themes as reflected in the charts. We have a lot to talk about today when we get to our market recap here. We had a Zweig breadth thrust that was fired on Thursday. On Friday's close. Friday's show actually was a special episode featuring Grayson Rose and I sharing our top 10 charts to watch in November. 9 stocks in an ETF. For the most part, still setting up quite well here as we go into this new week. Last week was all about strength. The week before was all about weakness. What will this week hold? It's all about breaking down some of the charts, seeing what levels, what lines in the sand we want to pay attention to. With that in mind, let's get to our market recap and see how the charts evolved today. Before we get to the chart, by the way, I do want to share we asked a question recently on our social media platforms and here on our YouTube channel. What is your outlook for U.S. stocks over the next 6 months? Bullish, bearish, or neutral? In this first time we've asked this question, I think in quite a long time. I think we might try to get in the habit of asking this every Friday just to see what sort of results we get over time. But as of this last time, 47.4%, almost 50% of you saying bullish. That's about 22% neutral, about 31% bearish. So certainly bulls outnumbering bears in this survey of StockCharts TV viewers. And again, I think the kicker in that question is 6 months. I would argue I am not convinced that the current trend is positive, certainly on the medium term. I think this market still has quite a bit to prove to give the thumbs up fully on a bullish sentiment here on that medium-term time frame, although the short-term tactical time frame clearly strong after last week. 6 months out, though, is quite a bit, right? That's going into the beginning, sort of middle of next year. It's going into April, May of next year, which means either you see that we are recovering, we're sort of chopping around here going into year end, and then we sort of continue this uptrend into the new year, or the prospect of inflationary pressures, the Fed maybe continues to keep rates higher for longer. Maybe events escalate in the Middle East. All of those combinations could easily cause stocks to go lower. If the dreaded R word, recession, comes to play, maybe stocks are lower 6 months from now before recovering. Likelihood would probably be for strength, and I would say bullish for now. But let's, as always, reflect on how the charts evolve over the next 6 months. That's the beauty of a question like that. It's forward-looking from here, but there's a lot of game to be played between now and 6 months from now. So best answer, I would say, is focus on the trends. Follow those trends as they shift downwards and upwards. With that in mind, let's go to our market recap here and dig into some of the charts today. As I mentioned, basically an unchanged day. There's a bit of a pop to the upside in the last 10, 15 minutes of trading. Overall, the S&P finishing slightly higher, about 0.2% to around 4366. The Nasdaq Composite leading the way a little bit further up, about 0.3% higher. You can see mid caps and small caps actually down on the day. The small cap S&P 600 index down over 1%. The VIX down into a 14 handle. That means 14.9. That's below 15. It's interesting when we look at the VIX. My general back of the envelope level has been 20, right? Simple is the VIX above or below 20, and that tells you very simply, are we in a high volatility or low volatility environment? I really took to heart my conversation last week with Tim Hayes, who's a macro strategist at Ned Davis Research. They have a very evidence-driven process there at Ned Davis. His work and their work there really focuses on, I think it was 28.5, 28.50 was the key level with the VIX. And as long as we remain below that on spikes in the VIX, things just aren't getting that bad. But the times when it's gotten above 28.50, those are the real bearish cycles. So like early 2022, that's what happened. not at the end of the move, but at the beginning of that deterioration. So for now, well below those bearish thresholds, both 28.50 and 20, far above current levels. So for now, the VIX is saying things just aren't that bad. The uncertainty, the fear gauge is not that extreme. Interest rates pushing back to the upside. Now that's been one of the real factors I think in 2023 that we've been talking about. I think continues to be an issue. When the market moves up, it feels to me like investors are basically ignoring what higher interest rates really mean for consumers, for companies, for banks, for all of these parts of the economy. That really higher rates are sort of a hindrance to taking action. That's probably going to help the markets in the long term. So higher rates by the Fed at the short end are literally designed to slow down the economy, to slow down borrowing, to slow down spending, give the market a chance to catch up, and then when things start to improve, that's when they're able to raise rates again. So for now, certainly rates remaining elevated relative to the last couple of years, but pulling off of those extreme levels. The 10-year yield touched 5% here in the last 6 weeks, now coming back down just below 4.7%. The long bond yield just above 4.8%, 5-year point just above 4.6% as well. The TLT bond ETF came down about 1% today. We talked about that bullish divergence last week with the TLT, with the ag, some of those bond price ETFs had lower lows in price, higher lows in momentum, traded higher. For now, today kind of coming off. I think that's something to watch to see if interest rates push back up there. 10-year yield above 5%. I would argue not good news for stocks. I think the bear case for stocks here involves yields going higher. Dollar index really not much of a change from Friday's close. Looking at commodities, a bit mixed here. Crude oil prices essentially flat. You'll see things like natural gas actually down quite a bit. Gold and silver down but less than 1%. The GLD was down about 0.8%. Spot gold testing, $2,000 an ounce, but coming off of those levels again. So, gold really has had quite a bit of an improvement here in the last 6 months. The question is getting above sort of those significant resistance levels. I mean, $2,000 an ounce is near all-time highs, around $2,100 an ounce. So we're not too far below those levels. But for now, the GLD not quite following up through that breakout just yet. But I think that's something certainly to watch. Silver also down slightly. Finally, looking at cryptocurrencies, not too much of a change. Bitcoin currently holding steady right around 35,000. Ethereum just below 1,900. That's not too much of a departure from last week with Bitcoin. We talked about that break above 30,000, 31,000, got up to around 35K and sort of stalled out there. That's sort of the new plateau of sorts. We'll see if there's enough momentum to get above that 35K level. Ethereum 1,900 for now, serving as resistance. I think 2,000 is that big round number to be looking for. Above there, pretty constructive follow through if and when that would play out. Looking at the sectors here very quickly, healthcare, technology, consumer staples are your top 3 leaders. Only 4 of the 11 sectors, by the way, actually finished in the green. That's worth noting. And a lot of these kind of popped up here right at the end. So healthcare and technology both up about 0.7%. To the downside, you have real estate. We have down 1.33%, energy down 1.1%. Then it goes to materials down about 0.5%. So overall, quite a bit of disparity between the biggest gainer, healthcare, the biggest loser, real estate, everything else sort of in the middle. Now, I'm continuing to be drawn to things like utilities. Some of the biggest gainers just in the market today. Zooming out and looking at some of the key stocks. Here we go. CEG. These are Dominion Energy. These are utility stocks. So when some of the top 10 gainers in the market are utilities, consumer staples like Clorox, these are not feel-good names in the top 10 of the S&P just on one day. So let's not draw too many long-term conclusions from short-term data, but certainly something to pay attention to. As we, again, I think for me, it's sort of a question mark. You've had short-term strength. We'll look at the chart of the QQQ here in a minute. We've had medium-term weakness, and I would argue that with a lot of charts, you really haven't seen enough of an improvement, I would argue, yet to really complete that rotation to a bullish phase on that medium-term time frame. So now it's all about the details. It's all about looking to see what happens now that we had that big, rally week last week. What are the biggest gains in 2023? To be sure, do we get follow through this week? Less earnings, or certainly less market cap represented in the earnings. So a lot of questions to think about. I should have mentioned, by the way, at the beginning, I did mention the live Q&A. We'll be going to questions here in a couple minutes. Get your questions in now. I see some questions coming in the chat. Pop them in there as I go through the recap. We'll get through as many as we can in the live Q&A. Anything we don't get to, we'll make sure we put it in the Final Bar mailbag for the next time we have a special mailbag segment. So, a couple charts to sort of complete this discussion. When I was looking at the QQQ, I actually did a YouTube video on my own channel called Market Misbehavior on Thursday or Friday, if I remember right. And one of the things we talked about was basically that, if you look at that short-term tactical time frame, there's no denying last week was a strong week for stocks. Strong week for the benchmarks, certainly a strong week for growth stocks. You had Apple's earnings in there, which again, were not particularly rosy earnings. However, mega cap tech, mega cap growth doing just fine last week. The QQQ, pretty much just these beautiful up candles, some gappy days, finishing at the upper point of the week. But if you look back, that's pretty much what these counter trend rallies in early October and the counter trend rally in late August have looked like. I mean, almost the same. I took the same line and kind of copied it over just to show how similar these levels are. They're not too dissimilar from one another. And what's interesting about that is this takes us back to the upper end of this trend channel. What's interesting is some stocks, and I want to say like Microsoft, we'll have to look at it in here in a minute. I think Microsoft has actually broken above a trend line using these highs. But if you look at semiconductors, if you look at the QQQ, if you look at a lot of other growth names, they haven't quite broken out yet. And so I think short term, no denying this is a strong upward move, but I'm skeptical of growth stocks able to power through and just blow above some of these previous levels. For now, I think I still have to consider it, a downtrend channel of lower highs and lower lows. Get really bullish when that changes, but it's not been enough yet, right? It's not really broken out. It's not broken above the most previous swing high in October, for example. That YouTube video that I mentioned, we talked about two other time frames as well. So if you didn't get a chance to look at that, I would do that. I'll fill in some of the blanks of what I just showed you there. Another thing I wanted to point out was a breadth indicator. There's a breadth indicator called the Zweig breadth thrust. There was some noise at the end of last week. Now, I think for good reason. This indicator, by my reading, actually fired. I had some debate with some of my peers in the industry. I think there are a number of different ways that people have decided to measure something like Marty Zweig's breadth thrust or breadth thrusts in general. So let me just quickly describe what this indicator is telling you, why it fired, and what it means. The Zweig breadth thrust basically is a measure of breadth, and it fires when conditions, number one, are very negative. Breadth conditions are very weak, and then in a very short period of time, breadth conditions get very strong. And so the way that this particular one is calculated, and that's breadth thrusts in general, that's kind of what that phrase means. What Marty Zweig, who is a famous market strategist, talked about was he looked at the 10-day exponential moving average of the advancers versus the total listings on the New York Stock Exchange. And when the indicator goes below 0.4, that's an initiation of the indicator. Within 2 weeks or 10 trading days, it needs to get above 0.62, which would get us above the orange line. And so we have an indicator on StockCharts, exclamation point BINYBT, which tracks this breadth thrust, this Marty Zweig breadth thrust indicator. As I mentioned on Friday, it did go from below 0.4 to above 0.62 within 2 weeks, and that causes the indicator to go to 1 or to signal. Now, I've just created this on the top here, overlaid it just to show these vertical, basically these little drops or these pops in the breadth thrust indicator show you that the indicator has fired. And what happens is if you go back for 16 years or something, what's cool is you can look back and see when the indicator has fired previously. Don't worry about the noise at the bottom. Just look at where these orange lines are. So our friend Ryan Dietrich, who's a friend of the show, he's been on our show before on the Final Bar. He's at the Carson Group, a great strategist, very technically oriented. He shared the fact that pretty much 100% of the time, 12 months out, the market has been higher. If you look at the breadth thrust going back, and what this tends to mean. If you look visually at the chart, you'll see that for the most part, that tracks pretty well, right? It in general tends to be a good signal. My skeptical way of analyzing this data briefly, and I've done it actually a lot more than briefly, would be this. I think it has a lot less to do with the incredible, prediction, the predictive power of the indicator saying that markets are going to be strong. I think it has much more to do with the fact that to initiate the indicator, the breadth has to be very, very weak. And if you look back in history, anytime market breadth has been really weak, and then you look about a year out, markets are pretty much stronger. And that has less to do with a magical breadth measure and more to do with the fact that stocks in general go higher. So if you buy severe weakness of a lot of different types, you're probably going to do well a year out because that's what tends to happen. Stocks in general tend to go higher. So in general, this has been a pretty effective indicator, and that's why I wanted to highlight it. I would point out there are times when it's not been as particularly strong, and I think 2015 to 2016 is one of the few times where I actually made a new low after the indicator was fired big, and after that, it was kind of lights out to the upside. So that is the Zweig breadth thrust. That's an indicator that fired on Friday's close, and again, happens very rarely, and it's tended to be pretty good news when it does happen. So if you weren't familiar, hopefully you are now. Let's see, what else can we look at? Just a couple names just to finish off here, and then we'll get to the live Q&A. Disney is a really interesting chart. When we think about earnings this week, there are a number of companies reporting earnings. We're still in the meat of earnings season. I think it's about 10% of the S&P reporting this week. I might have made that, and that rings a bell from something I read over the weekend, but it's a bit of a blur. I'm pretty sure there's a lot of football happening, but I'm pretty sure that's what was. That was what I read. Not as much of the mega cap names, none of the Magnificent Seven names reporting this week. Those have kind of have played out. But Disney is one of those notable ones. And I think what's interesting about a company like Disney reporting earnings, they report on the 8th, by the way, which is Wednesday of this week. Disney's coming off of a very low level. Now, this is a group called the Entertainment Group, according to our industry classifications. But it's really sort of in that media conglomerate type of bucket with like Warner Brothers, Discovery, those types of names. Disney, of course, pretty diverse business, as you know. But the trend overall has been very weak. Now, one of the questions I got last week just from the mailbag was, is this a double bottom for Disney? And my answer would be maybe. But the way that you validate that this is a double bottom to be bought, I would argue, you have two approaches with something like this. Either buy weakness and bet on it going higher and just use money management to minimize any downside, or you wait for an upside follow through. And I think that's what's happened with Disney over the last week. This rally last week put it right up to resistance, right around $86 a share. I'd be more constructive if we get above that level. I'd be more constructive if we're above the 200-day. As we've mentioned many times recently, nothing good happens below the 200-day moving average. So I would argue this chart still has quite a bit to prove. What's great about earnings, that often can provide a big catalyst to move the needle very, very quickly on a name like Disney. So that's something I would be watching out for. I feel like that's enough of a market recap. Can we get to the question? I see some questions in there. I want to make sure we budget enough time for it. Before we get there, by the way, as a reminder, we have the chat open every time we do a live broadcast on StockCharts TV. I'd encourage you to use it. We'll go through those, and if we don't have time to answer live questions during that particular show, we will capture all of them for the Final Bar mailbag. We've had some really good questions. We'll get to as many of them as we can here in the coming weeks. If we're not live, and if you're just watching a video on our YouTube channel, something comes up, drop a comment below the video on the channel that you're watching, or just email us at thefinalbar@stockcharts.com. On X, tag us in a comment at FinalBarSCTV. We love hearing from you guys. We'll hope to answer as many questions as we can with different formats on the Final Bar. Let's get to the live Q&A and see what we can see what sort of questions we can answer. Let's see. Can you recommend someone who trades divergences? Marty asks. Great question. Can I recommend someone? A lot of people actually that I don't know if I would recommend someone in particular, but I will tell you divergences can often be a really compelling reversal signal. It's something we've highlighted that we've seen pop up a number of times recently, right? And a divergence, a bullish divergence, is what you're often looking for in a name like Disney, which is lower lows in price, higher lows in momentum. Arguably, you got one in September and October, maybe making the case for this double bottom type of pattern. A lot of other names you've seen that bearish momentum divergence. I want to say like the QQQ, but let me bring up the tape there to be. Yeah, it really wasn't a divergence, was it? It didn't happen with the QQQ, but it did happen with other names like Microsoft and Apple, for example, had this situation where you made higher highs in price and lower peaks in momentum. It does work on both sides. I've seen bearish momentum divergences work at tops, and I've seen bullish divergences work at the lows. In my experience, it's a much better topping indicator than a bottoming indicator, just because of the nature of how markets tend to top, because you kind of have that final push forward. There's that last bit of accumulation. The momentum slows down before we kind of roll over and drop off the cliff. And so that's something I would be looking for. Anytime there's a stock that's rallying, you're looking for momentum to not confirm a new high, and that's maybe the way to think about it. In a downtrend, you want to think about the market price making a new low and the momentum not confirming that new low. So those are the general ways I would think about divergence. We have some great content on StockCharts TV that we've done. Just bring up our channel and search for the keyword divergence, and you'll see how much it comes up on some of the shows that we do quite a bit. Let's see. What do you say to the people that said the selling in late November was mutual fund selling and rebalancing? Late. I was going to say. I think you mean late October, which you did say, Rev. Thanks so much for that. Totally fair. I think what you have to remember was something like, with the S&P, and I actually didn't even show the daily S&P chart as I'm thinking about it as I went through the market recap. So let's go there next. Is there an argument that this rally here was, end of the month covering? Maybe. And I would tell you, anytime the market moves in a big way, people are desperate to find a reason. What is it that caused this move? And I don't disagree with that need to do so. That's a very natural human, mentality to sort of think something happened. Well, why did it happen, right? You need to know the why. I think what you have to remember, though, to be honest, having done this for a while, sometimes the markets just move. And a lot of times, if you can't explain what it is, I find it attributed to short covering or people being on the wrong side of things, people caught on the wrong side. And there's this idea that anecdotally, people get caught on the wrong side. And they have to swing in and change their position very quickly. That certainly has happened. I don't know if all of the times that things are attributed to that is actually why things happen. You have to remember that most market professionals, unless you're at a trading desk, where you're literally trading in a dark pool and you literally are calling big orders to different shops, then you get some visibility in terms of what actors in the markets are actually doing things. And when a stock moves, you can learn what kind of orders move them. But on average, I would say most people are not particularly don't have a lot of clarity on what caused big moves at certain times. You can often attribute it to earnings. You can attribute it to inflation, you can attribute it to macro factors, but a lot of times we're estimating and we're making a lot of assumptions based on price and volume and sort of news flow to kind of do that. Having said that, there is a well-documented factor at the end of the month for sure. Certainly at the end of the quarter is a little more common. So at the end of September, I could get the argument a little bit more. Was this a big change at the end of October? I don't know if I would buy into that as a main reason why the market would have rallied. I would argue that the big you're talking about the big selling here as being that sort of thing. I don't know if I would completely agree with that. I would think it's more, a lot of times news outlets will write it off as technical buying or technical selling, and I will tell you, having been involved with firms with news departments, that is sort of the shorthand of we don't really know, so we'll call it a technical thing. It's basically you can't really describe it for some big reason, so it was technical buying or technical selling. I think the fact that the market sold off for decent reasons and then became so oversold that obviously investors come in and buy on weakness, I think it was more that than anything about big funds changing positions and selling and buying back in there. I don't know if I would necessarily agree with that. I would think mutual funds are desperate to be on the right side of things. And the reality, though, that I would say, and sorry for the long-winded answer, one of the things to remember is if you are a large money manager and you're running a big mutual fund, like a $10 billion mutual fund, and your benchmark is the S&P 500, you have a huge risk if you don't own those mega cap names. And so I think one of the reasons why those mega cap stocks have continued to do so well is because you really need exposure to them if you have any chance of beating the benchmark, particularly when they're doing well, right? And there have been times when you don't own an Apple or a Microsoft or a Meta and you get crushed just because you didn't own that one name and that ended up being the big gainer. So I think that sort of pattern of mega cap dominance continues to perpetuate. I think that's some part of that are big institutions that are forced to own those and forced to layer in if they go up at all. Great questions, by the way, about some of the drives behind it. Let's see. What is your personal criteria for exiting a stock, commons, and options trade? I think you mean just like a stock or options trade. Is it purely by levels, or do you look at a percentage stop loss? No, really good question. Thanks for asking about that. With stops, we could do a whole day-long masterclass on how to think about stops. That actually came up. I mentioned the special that we did on Friday, and again, I'd encourage you to go check that out. Grayson and I both shared 5 stocks we were watching in November. Actually, 9 stocks and an ETF. I threw gold in there, gold stocks, but worth watching because we talk a little bit about the risk versus reward and how you would manage, risk. We intentionally stay away from a lot of that on StockCharts TV because our job is not to recommend things. We're not trying to help you structure a particular trade. We're trying to empower you to illuminate the markets and give you the tools you need to make better decisions on your own. But I would say there are a number of different sort of generally accepted ways to think about risk and managing downside, and not to just sit on the chart of the S&P this whole time. So let's go somewhere. Let's go somewhere else, like an Apple, for example. So let's say you're buying Apple today, right? And for whatever reason, let's say you bought it today, and then you're just thinking about the risk versus reward. Um, so I would say that the general way that I think about it is I always say start with the final bar, the current bar, and look to the left, and just sort of think about what levels stick out to you. So the couple different ways you can do it. In my way, the way that I would generalize it are: number one, do the blunt instrument approach, the shotgun approach. The really most simple, basic way is to do some sort of percent stop, and that is well promoted by like William O'Neill, Investors Business Daily type of mentality, which I think is very, very good. Stock goes down 8% from your entry point, you exit it, and no questions asked. Right? It doesn't matter what you think, what you think might happen. What's great about that is it's very easy to implement. You basically even put in an order. If it goes down 8% below this level, but at this point, I'm out, and don't even worry about it. It's triggered. You were stopped out. Move on to the next thing. What's great about that is it's easy to implement, and there's no thought involved. I mean, it's just kind of done. The bad part about it, though, is it's not particularly dynamic, right? So let's say you have a very volatile or a very not so volatile stock. 8% might not be the right number. So the second thing you can do is use a technical signal, right? I'm long Apple, but if we break below the 200-day moving average, I take half of it off the table. If we break below the most recent swing low, which would be around 165, maybe I take the other 50% off the table. That would be a basic way to use some, well-documented technical levels and just use those as your stops. If you're trying to think of who would be good at that, someone like a Doug Bush, who's been on the show many times, a power StockCharts user. If you go to some of his interviews, when he's come on the show, he's done a really good job of explaining upside to here. Here's where I would limit the risk, right? Here's the support. Here's the downside risk. The third way, and this is where I would encourage you, hopefully, to get to. I mean, the first way is the easiest, and it's not the best, but if you have nothing going on, use some sort of basic money management approach. Second best, I would say, would be a technical level, and that's where I usually end up because I'm not trading a ton, in personal accounts. That's kind of where I think it makes sense. The third option, where you really want to get to if you want to be a little more rigorous about your stops, are to use average true range, because that's basically a volatility-based stop. So the more volatile the series, the wider the stop. The less volatile, the tighter the stop. So it's a little more dynamic. And so something that uses average true range is usually a really good place to start. I would encourage you, if you want to dig into that, we have the indicator called Chandelier Exits. This is an indicator promoted by Dr. Alexander Elder in some of his books that are, fantastic reads. I think sort of the basic read book list of a new trader should include some Alexander Elder. And he talks about the Chandelier Exit, which is basically a dynamic exit based on average true range. You can overlay those on StockCharts, and I'm sure other platforms as well. If you want to dig into that, click the little magnifying glass, type Chandelier, and you'll get some articles from our chart school talking about that. So that was a long-winded way about how I think about it. And again, I'm kind of in that second one, a technical-based support and resistance. The other thing that I would tell you, if you do get to that point, what's great about that one, and this was a trick that Grayson Rose shared with me a long time ago. We have an indicator called Auto Support and Resistance. It's on Sharp Charts, and it's also on our ACP platform, our advanced charting platform. If you click on it, and then just click the line. It's a simple horizontal line, but the line is green if the price is above the support. It's red if it's below it. And for setting a stop, I think it's really, really great. Put a chart list with your holdings, put these auto support resistance levels at your stop, and then as you're going through the charts, however often you're reviewing them, it's a quick visual check. Is the line green? You're still okay. Do I need to move my stop up a little bit? Great. Is the line red? My stop is triggered and I need to exit a position. It's a quick visual review to make sure that your stock is above key levels you want to pay attention to. Okay, great question there. Sorry, we've had some long-winded questions or long-winded answers by me. I'll try to be briefer. Hi, Dave. Michael asks, what do you think about Apple now that it's breaking out of the channel we've been watching? Yeah, I had this up. I was wondering if someone was going to ask about this. I figured someone would, so I kind of ignored it a little bit in the market recap. So, I think, with not to make a huge line here, but I think when you look at Apple, when you look at the QQQ, when you look at the semiconductor space, a lot of big growth stocks kind of have this similar type of pattern. I think with the Qs, it's as clear as I think you're going to find. On the QQQ, it has not quite broken out yet. Apple today actually just closed above this trend line. If you're using the log scale, which you all should, and if you draw a trend line off of the recent highs, we broke above there. So what do I think about Apple? So I would say any signal that I would ever talk about has three parts. It has a setup, a trigger, and a follow through. It has to have those three, I would argue. The setup is this looks like a downtrend channel of lower highs and lower lows. The trigger would be we close through that trend line. The follow through would be either we continue to go up to some degree, or more of a specific follow through, and that's where I would kind of come in. Impressive today that we've closed above this trend line and above the 50-day. What I'm not convinced on yet is we haven't made a new swing high. So as of right now, we're still making lower highs and lower lows. And when I sort of explain that medium-term time frame, I'm still on the bearish side of the coin. It's because of that. A breakout is great. That's good, and that has to happen for a bullish rotation. But what would convince me that Apple is bullish? We get above that resistance, the momentum improves. So the RSI is right at 60, which is where it usually stalls out in a bearish phase. So the problem is we roll over tomorrow and make a new low into late November. This chart will look like the most classically bearish downtrend you've ever seen. We're just not enough of a breakout yet, I think, to give the all clear sign. For me, it's Apple getting above 183, we'll call it, which would be above the swing high in October, and the RSI has to push above 60. That's what I'd be looking for on the chart of Apple. What's interesting about this is on the chart of Apple, you're kind of right between these two extremes, right? Either that happens or we break back below the 200-day moving average, and as we've already mentioned even on this show, nothing good happens below the 200-day. So holding the 200-day is pretty important, I would argue, with the technical strength of a chart like Apple. We dipped below that in late October, and now it bounced back above. So which of those breaks happen? That's why I think this market is still kind of in wait and see mode, as much as you might want to be really bullish. And I don't disagree with the short-term strength. I just don't think medium-term I've seen enough to be convinced there. Let's see. TNX up, dollar up, market up. I don't know if that's a question, but more of a hashtag truth on that one. I would not disagree with you. But let's look at some of those. Yeah, in the market recap. Sorry, I'm usually pressed for time, and I'm trying to hit on different things. With the 10-year yield, I still see yields as very high, and so even though the 10-year yield has gone from 5% down to about 4.5%, and now up to just below 4.7%, we're still at the upper end of the range that we've been for the last couple years. And I would argue, while we've seen a bounce in bond prices, while we've seen a pullback in rates, it's still above the 50-day moving average. It's still not too far below the highs of the last 12 months. I still see rates as fairly elevated. Higher interest rates just are not particularly strong for growth stocks and for risk assets. If you don't know what that means, what the sentence that I just said, go to my conversation last week with Tony Dwyer. I thought he did a fantastic job of just describing a liquidity-driven bull versus bear market, what interest rates are really telling you, and about the level of rates and what they mean. That came up with Tim Hayes of Ned Davis last week as well. Two really good conversations about just trying to put the Fed and rate hikes and rate, lightening of interest rate policy, and just the level of the 10-year and what that probably means. Elevated interest rates, if they just stay at this level, I would say over time, that's worse and worse for growth stocks. The bull case for stocks, I would argue, involves lower rates at this point in the cycle, is how I would describe it. Dollar's an interesting one for sure. One of the charts that I have in the Mindful Investor Live chart list is this one called Currencies and Commodities. And we have the dollar at the top, we have crude oil in the middle, and we have gold at the bottom. Now, if you look at what happened in September, strong dollar, strong oil, weak gold. Look at what happened in October, flat dollar, I would say probably, weak oil, strong gold. So those two at the bottom kind of flipped, and the dollar, didn't really break down, but just sort of stopped going up. Now, what happened going into the weekend is the dollar actually made a new swing low. It actually broke below support. Today, it actually bounced up a little bit. So I think this is a pretty important chart. What you have to remember is between mid-July and now early November, a period when stocks in general have been coming down, the dollar has been particularly strong. So again, I would argue if you're bullish on stocks here, I think you want to be cheering for a weaker dollar. The dollar and stocks have been, generally speaking, inversely related in 2023. I don't see any reason why that would necessarily change right at the moment. So, weaker dollar is pretty important to the bull case, I would argue, for stocks. So certainly a chart to watch. It looked like it was going to break down big time on Friday. Really didn't follow through yet today through the course of this week. That's what I'd be watching for sure. Let's see, continuing on. Let's see. Sorry, we got a lot of questions in here. I really appreciate all of these. Hi, David. Andrew Sullivan asked, and you have a Patriots logo. I don't know if I can take your question, Andrew, but I'm going to do it. And shout out to the Browns winning and blanking the Arizona Cardinals this weekend. We will not talk about my Seahawks. You mentioned not to worry about gaps from long ago. What do you think about the very recent gaps left behind by the S&P 500 and the Nasdaq? I'm wondering where that comment. I feel like you're taking that comment out of context. I don't know if I meant ignore gaps always. Hopefully I didn't say that. What I would tell you is, I think the question was on gaps from further back and how important they are. And I would say in general, right, on any chart, if you're looking at the SPY or the Qs or an individual stock, something that's going to have those gaps, I think it's all about where we're at right now, and then you look to the left. And the closer we are to the current date, the more important those gaps are. So I would argue these gaps from last week, very important. If we would start to roll over, I would be very keenly aware about where we are at, certainly for that last gap. For this other one, this is sort of that big initiation. I mean, if this is a sort of breakaway gap, meaning this is the end of the down move and sort of the beginning of a new up thrust, then that gap certainly has to hold on any pullback, or else that thesis kind of goes out the door. So I would argue gaps more recently super important. The gap here from mid-September is pretty much where resistance was in October, and I think that's yet another reason why that serves still as resistance right now this week, right? So getting above 440 not just gets us above the October swing high on the S&P, it gets us above this gap from mid-September. So I would argue gaps certainly are important. Another one would be this gap here, which would be what's called a breakaway gap to the downside. You have sort of the end of this move. And then this gap lower ended up being the beginning of this downtrend channel. So that served as resistance here, and a rally up here. That certainly means that would be a key level. So I do think gaps are important here. And I think these ones higher means, certainly this one here, which would be from, I think that's Wednesday of last week. I would be watching that one. And any pullback, we hold that. That would also mean we hold the 200-day on the S&P. That's not too bad. We start breaking below that. I think any bullish sentiment you're feeling from this rally from last week, not so rosy anymore. So I think they are actually pretty relevant here. Thanks for asking about that, by the way. Let's see, DraftKings, and I can only assume from your aggressive use of emojis that you think it's bullish. I don't believe it's a blur of sorts because I've published a lot of content since last Friday, but I don't think DraftKings was one of our 10 charts, but I will tell you that as I was reviewing charts preparing for Friday, I looked at it and I remember talking with Grayson as we were prepping for the show going, oh man, DraftKings was a really good one. Too bad we didn't pick that one because it was really good on Friday. So no, we didn't include it. Is that impressive? Absolutely. I think anytime you have a chart like this, which is a rally, and then I would call a basing pattern. A basing pattern is anytime you have sort of the sideways consolidation, bit of a lower high here, but the support really consistent, right? So 26 is kind of clear support from August, clear support from October. We've now broken back above the 50-day and pushed above those highs. Friday, I was concerned about, do we get above there? I think today is a nice follow-through with DraftKings up another 4%. I don't have any problem with that chart, especially because the momentum has come up, right? So the momentum getting to the overbought region, that often means, maybe a brief pullback off of the strength, but overall, I think there's a lot to like on a chart like DraftKings, maybe re-exerting itself to the upside. Awesome questions, you guys, and thanks for putting a lot more in there. As many as we can get to, we did. We'll put some of the other ones in the mailbag, and we'll hope to get to them later this week and beyond. We have to wrap the show, folks. You go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here, folks, is chart number 1. I had fun with the StockCharts platform and creating some color-coded shaded areas. I did this just using the annotations engine on Sharp Charts, where we kind of laid out some of the, just basically did rectangles in different colors based on some of these trend lines I'll mention in a minute. I will tell you this particular technique, which you might call like a stoplight analysis, is something we are building into the StockCharts platform. I don't know if it's ready yet on ACP because I've seen a demo version of it, but I don't know if it's out in the public just yet. But if not, it will, or it should be very, very soon. This is basically you set a couple levels and then it automatically shades the chart based on where you're at. And I think that's a brilliant way of just summarizing key levels, thinking about risk versus return, thinking about breakouts versus breakdowns. When I'm looking at the chart of the S&P, I basically cleared off the chart over the weekend and just started from scratch. What levels stood out to me? Which levels do I think are important right now? 4,400 I keyed in on because it's the upper end of this gap, getting to our question earlier. It's also basically right around the high from mid-October, and that's not too far above current levels after this rally from last week and so far going through today. We get above 4,400. That would get the S&P above those levels, which would all be bullish. It would also get the S&P above its own trend line from late July and late August and September highs. So I think that's an important level to get above. S&P below 4,400 at best is neutral. Above there, I think that's a pretty strong chart. On the downside, 4,200. That's a level we've talked about quite some time. We've covered that, I think, well. That was a level we focused on. The break below here was a very negative sign. We then back above, so I think it's back to neutral. We get back below 4,200. I think this is a very risk-off scenario for stock. So those are the levels that I'm watching. I'm curious, as you are looking at the S&P, what would your stop light look like? Think about that, and that's the kind of question I would be ready to answer. Chart number 2, let's talk about those mega cap technology names. The 3 biggest stocks in the XLK are Microsoft, Apple, and NVIDIA. I'm pretty sure in that order now. Microsoft, the larger between Apple, given some of the deterioration here and the rally that you've seen in Microsoft. When you look at the chart of Microsoft, it's broken above its recent swing high. So out of the 3, probably the most constructive in terms of upside follow-through, I'm looking at the July high, looming large just above current levels. Apple, number 2, as we mentioned in the Q&A segment, breaking above trendline resistance. My question for this, does it continue? Does it follow through? That third piece. We have the setup, we have the trigger. Do we get the follow through? That's that third piece. NVIDIA, probably the least attractive of the 3, but it did hold key support at 400. I think NVIDIA above 400 just isn't that bad of a chart. And when you think of other charts like Disney and others, just in clear downtrends, this is a stock that has not gone in a downtrend yet, but it is this really toppy pattern, which means a break below 400 for NVIDIA would be a really bad sign for the stock and also for the semiconductor space. Finally, I run my market trend model on the S&P every week. On Friday, the short-term model turned back bullish, so it's short-term bullish, medium-term bearish, long-term bullish. Right now, I'm looking at the TLT, and it's bearish on the long term, bearish on the medium term, bullish on the short term. So when we talk about that bounce higher in bond prices, that pullback in rates, keep focused, I would argue, on the fact that the trend for bond prices still very much down until we get further upside follow-through. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Thanks so much for participating in our live Q&A. We appreciate your questions so much. Don't forget to like this video and subscribe to our channel while you're here. We are getting very close to 100,000 subscribers. We would love your help getting us there. For StockCharts, I'm Redmond, Washington. I'm Dave Keller. Be well, stay safe, have a good night.